All right.
Good morning.
Good morning. Well, welcome to Wealth Doctors. I'm Dr. Stephanie Ardrey.
And I'm Dr. Andrea Lee.
Hey, good to see you, Andrea. How are you today?
Good seeing you this morning. It's better. For the last couple of days, we got so much rain here in Southern California. I think we got enough rain for the whole year. Uh,
Exactly. Are you okay?
in my area, we're okay, but some other areas are completely flooded. The freeways, but it's getting better today. The sun is coming out.
We have a little peak of sunshine here too. It's interesting. I don't think we had the harsh floods, but definitely Vegas got a little rain. And of course, everyone's here expecting about, I think they said another 500,000 people on the strip for Super Bowl week. So
Oh wow.
I, I use the rain as an excuse to stay inside, but I think I better get out eventually.
Yeah, when the sun is coming out, right?
Exactly, exactly. It's a safe time. So this week, what are we talking about?
Yes. So, well, happy Wednesday, everyone, and thank you for tuning in and be with us for another, episode today. And as usual, we are here every Wednesday at 10 a.m. Pacific time. Last week we discussed different type of insurance. This week we are going to talk about annuities.
Woohoo! Annuities. Excellent. Excellent.
Annuities,
Yes.
yes. Um, so there's so much information about annuity. What is the most worry as you enter into the retirement years? Do you think what's the most worry is?
Well, oh, it's outliving your money, especially because we're advocating that full life is 120 years and beyond. And most people think about retirement at around 60 something. And it's like, what if you live another 60 something plus years?
Right. The technology now is improving medical health. People are living longer and longer, right? So it's we have to plan in advance because you can't live until 90 and you're running out of money. That's going to be hard. Or
Absolutely.
in the 60s that you have to re-enter the workforce, that's very difficult too.
Absolutely. Even I think last week we touched on the fact that if you have a real estate, which a lot of times people invest in their residential real estate, but you can find yourself in a situation that you can't even afford to downsize and replace that real estate. You can't necessarily pull income out because the price of replacement real estate can be the same or more than the value of your existing real estate. So that's not necessarily a safety net, especially if you have all of your money tied into that real estate.
Right. So it's good to have a wide range of investment portfolio or diversify your portfolio. Some you should have life insurance, annuities, stock, investment, real estate. So a well diverse portfolio will give you a lot of opportunities and minimize the risk. Right.
Absolutely. That's what we want to do. We want to minimize the risk and make sure that we preserve the principal and realize some growth, some gains, right?
Yeah, the
Absolutely.
principal protection is very important. So that will connect directly into the annuity because it is depend on what type of annuities you have, the principal protection is one of the most common or the most important one in annuity because you don't want to lose your principal and the interest that you earn already in the past year.
Yeah. So why don't let's talk about what are the different types of annuities that are most common?
Right. Before we jump into that, let's see what is the annuity.
Yeah. Let's lay
Right?
that
A lot of
foundation.
people
Exactly.
question what is annuity. We hear that term all the time, but we don't really know what it exactly means. Um, Annuity is very simple. It's just a contract between you and the insurance company that basically shifts a portion of the risk away from you onto the insurance company.
Which is really important. I mean, when we talk about, sadly, some of the disasters right now, and I
Right.
remember a news clip on a person, one of the persons who suffered severe mudslide damage, and was saying, hey, the insurance, the traditional property and casualty insurance would not cover that damage. So there's alternatives that you can have to property and casualty, meaning you can use your life policies in other ways to make sure that you have access to other ways of mitigating risks that you may encounter along the way.
Right. And also another good thing about annuities is you can use it. It can be used to accumulate funds for education, retirement plans. You can convert that lump sum amount of money into a lifetime income benefit that will last you for the whole life. Basically, its primary use to provide steady income, a stream of income, for individuals or even for a business. You can do that.
Oh, absolutely. I love the idea of using an annuity to come up with investment capital for your business, or to use annuities to create accumulation of capital and funds for, delayed expenses. I always tell entrepreneurs that you want to utilize these tools for things like, in business, you often find yourself in litigation, and not because of necessarily any fault. You can be successful and you can follow all the rules, but you can still find yourself along the business journey in need of a lump sum of resources to retain a law firm, for example, to represent you because of, whatever has happened. An annuity is a great place to place those funds just in case, right? It's great if you don't need them, but you have them. So I say that's one of the places where you can put some resources for a safety net.
Right. It is designed to protect against outliving the retirement income. Um, so that is one of the main purpose of it, but it's a great way to build your asset and wealth protection, also generational wealth as well from that. So you mentioned earlier the different types of annuities. The two basic type of annuities. First is the income annuities. So what it does is offer a payout for life or a set period of time in return for a lump sum investment. So you put in like 100,000, 200,000, depends, and you can um, get lifetime income from that amount. It can be immediate annuity or deferred annuity, which will discuss a little bit later.
Which, it
Um,
makes me think of people that, for example, have a big winning, or you win a settlement in a lawsuit, or big lottery winners. Where is it that they place those lump sums of resources to ensure that they have resources? Because what they say is, sadly, when you come into a large sum of money, oftentimes before you know it, that money is gone.
it's gone. If you put in the bank, it's gone, right?
Right,
And
right.
it's a lot of people would put their money inside, a bank because they think is the safest way to do it. It is safe, but it doesn't beat the inflation. You don't gain anything.
Exactly. Well, say for the bank, you're giving the bank an opportunity to make money, because guess where they're placing your money? In insurance.
And insurance and investment, right?
Right, right. So it's not so safe for you in terms of what it is. You're right. Key point. You can't even outpace inflation. So your money, every day that it's sitting there in the bank, you're losing money. You're losing money. It's going down in value. So that's not the best place. Sure, you want some liquidity in the bank, but the minimal amount, you want to diversify your capital and make sure that it's accessible, but it's earning you money and definitely outpacing inflation.
Right, absolutely. The second type of annuity is called deferred annuities, and this will allow you to accumulate tax deferred saving. What it can give you create a lifetime income in the future also. So the deferred annuities provide an opportunity for savings for tax defer, and allows the earning to compound over time. So this is a great way to accumulate cash and protect your principal.
Absolutely. And what's in a deferred annuity scenario? What's a typical time horizon? Are you planning like you have a 10, a 20, a 30-year window to accumulate funds within that instrument?
The sooner is better, of course. Let's say we have an example here. For a person to invest into annuity at age 35,
Mm.
if you put in 100,000, let's say for an index annuity, that's what allow you to accumulate cash over a period of time. So at 35, you inject in 100,000 for an index annuity. At age 45, potentially that amount uh, is grown more than double, 236,000. And
Wow.
at age 55 is 501,000.
Wow.
And at age 65, you are a millionaire. It's
Wow.
$1.2 million. So that is a huge growth for a course of 30 years. Imagine the sooner you start, the younger you start, the more compounding interest. Because here you're looking at triple compound interest. You earn interest on the amount that you put in, you earn interest on the interest, and you earn interest for the amount that you put in instead of paying to the tax. It can
Wow.
be, right? Tax deferred, right?
That's great. You know, it makes me think of last week when I was talking about the example of the $25,000 wigs. That's 4 wigs, right? That's
Right.
4
For a
wigs. You
wig.
have your 100,000. Much better decision about how you allocate those resources, right? Or that's a couple Birkin bags, maybe one, right?
Right. I mean, if you have the money as your disposal, you can buy anything you want to make you happy. But, you know, buying a wig won't grow the money, right?
Right. So some a little bit of I say differences in how you allocate the resources. You know, one of the things that I saw again that popped up on the news on one of my news feeds is a lot of times people look at the value of a consumer market based on the dollars that they spend in terms of consumption. And I saw a blurb about the African American consumer market in the US is expected to spend $1.9 trillion in the economy. And I thought about it and I said, wow, that's amazing because so many businesses, in particular, that are led by African Americans, you know, not a lot, not as many are at the top end in terms of growth as there are solopreneurs or, you know, kind of, you know, struggling from, you know, cash flow issues on the bottom end. So it's not about the resources, it's about reallocating the resources. So I always say, I don't think that many people have a cash earning problem. They have a cash spending problem, how they allocate their resources, that if they stopped and allocated their resources a little bit differently, they could accomplish different outcomes.
Exactly. Coming up with different plan and also um, the way that you say allocating, that is the most important because if you prioritize your retirement planning or your income protection, you can allocate some of that earning into that field and earning compounding interest for you over the years. So back to the example that we talked earlier, the 35 years old person invested put in 100,000 in an annuity. At age 65, you have $1.2 million, and at that point, you can activate your lifetime income amount. You could get out 73,000 per year for life.
Wow.
For
Now,
life,
okay,
yeah.
so what's being considered are the actuaries using the 120? Are you seeing that in the policies that have been written of late? Because the last time I looked at a policy illustration, it was up to 120, which I said totally validates what I'm
120,
saying.
yeah.
Yeah,
It can go
yeah,
up
yeah,
to lifetime. It lasts lifetime. So
yes.
until you die, basically.
Wow. Wow. Yeah. 73,000, you could do something with 73,000, especially when you think about at a typical point, usually some of your main expenses have been reduced. If you're a family, if you had kids, typically they're out of the nest and maybe they've graduated from college. So you've dealt with, those college expenses. Possibly your home is paid off, or at least you're in a situation where you don't have some of those early expenses. It's difficult when you're starting your family, when you're young, setting up your household and you have young kids, all of those additional expenses, but you're past some of those things, hopefully. And then at that point, to have cash flow, tax free or tax deferred, whichever
Tax
scenario
deferred.
you find
Mhm.
yourself in, can be favorable.
Right. And with the annuity in place, I mean, you can um, allocate, either divert some of that money into it. It grows tax deferred, but there is a way that you can allocate some of that money into a non-taxable bucket, and there's strategies for that. To yeah,
Absolutely.
basically to increase your asset.
Oh, it's so important. I mean, this is why it's important to have a bench of professionals. You want to have a great CPA. You want to have a great advisor, a financial advisor. You want to have a few folks on your team who are able to look at your individual situation and help you determine strategies. And it's not a one size fits all solution. There are certainly different strategies for each individual depending upon their goals and objectives. So you really want to build a team and build a relationship and know that as you hit certain milestones along your journey, you might want to change some of the decisions. Decisions you make at 30 are different than the decisions you make at 50, can be different than the decisions you make at 70. So depending upon where you are along that journey, you want to be informed about the best decisions, the best risk mitigation measures for you at that particular time.
Right. I mean, everybody has different financial scenarios, so that is something that it needs to be details and tailors based on your needs and your objectives. So back to the annuity, there are within the deferred annuities, we have there's fixed annuity. Fixed annuities, there is a guarantee fixed return, like a guarantee interest. Your principal and interest are guaranteed, basically. There's several reasons why the people would buy fixed annuity. What do you think those are?
Well, because you want to have a consistent understanding of what your cash flow needs are in an income stream, right? So sometimes you're paying for an income stream that you want to be able to access. Other times you want to make sure that you're mitigating the downside. So you may not want to have as much of your investment part at risk so that you can ensure that you're not, putting principal at risk and there's amount of growth. And then also you may believe that you have not only a certain amount of not only death, well, your death benefit is usually protected in most of the instruments. So what would you say? What's the last point of why it is?
Well, yeah, it's safety. That is a reason too, because mainly people investing into the annuity is it's a safe investment because your principal and your interests are protected. You never lose, it's not that risk. Also tax defer accumulation. Another thing is diversification too. So it's good to have a bucket of non-taxable, bucket of tax defer. So different kind of bucket that you can access your money.
And you definitely need to evaluate this because, again, I was looking at some information, I think it was a couple weeks ago, where we were talking about although tax deferment can sound attractive, at the same time, when those taxes become due, potentially you have paid off a lot of the things that give you deductions. And the one thing that we don't know is what the tax rate will be in the future. So you might find yourself in a higher
Absolutely.
tax bracket with
Right.
a greater tax liability. But that's when we get into instruments like premium finance products where you're able to literally put in place a policy that will address those tax requirements, especially as part of your estate planning. bucket to make sure that at the time that your heirs, for example, inherit what it is you're leaving, that the taxes have been addressed through another instrument as well. So there's a bunch of options that I think people need to be aware of so that they can explore. That's why it's so important to have, again, a team on your side to assist you with evaluating all of these different options. Insurance, it's not just insurance.
Right.
It-
It's more than that.
it's more
It's,
than that. Yeah.
yes.
Yeah.
A second deferred annuities that we want to talk about is called fixed index annuity. So this the return is tied to a market index, but your money is not directly invested into the stock market. So unlike direct investment into the stock market, the principal in the fixed index annuity is never at risk due to the market downturns. So that is a very, very important to to consider and to have, because it protects your principal, plus the interest that you already gained in the past year is locked in. You never lose that money. Did
Which
you
is
know
very,
that? Yeah. Do you know in 2022 there's over $3 trillion lost by the stock market in the retirement plans
yeah,
tied to the stock
devastating.
market? Yeah.
Devastating. I remember a lot
But
of people, yeah, saying that.
yeah, but not one penny is lost from index annuity.
Wow, that makes a significant difference. And it also is, again, a reason why someone would want to look at how much of their cash is being held, for example, in a bank account, because you're losing money every day that it's there, where you can put your money to work, in a safe instrument, something that's safer than what you think in terms of what the bank is
Right.
offering, right?
Right. I mean, instead of putting 100,000, 200,000, 50,000, or 20,000 even in a bank account, I mean, I would have enough for your emergency fund or liquidity, but divert some of that into an instrument that help you gain more money and compounding interest. Especially the fixed index annuity, you have the investment flexibilities. So this means it give you a different index that you can choose, like the S&P 500, the Nasdaq, Goldman Sachs. The different MSCG. There's different index strategy that you can diversify that bucket of money, and also the annual reset, meaning the past market ups and down don't affect the interest that you earn, and lock in gains. So that is great. Whatever you gain, you locked in. You don't lose anything. Principal interests are protected 100%.
That's so important. That's so important because, again, each time we go in through these various economic cycles, from a bear to a bull market, then there's setbacks, and depending upon, again, where your resources are allocated. And again, a lot of times people are not direct investors in the stock. So they forget to factor in the fact that if you're dealing with a mutual fund or some kind of managed fund, that there are a bunch of fees that you're
Yes,
incurring. And
yes.
oftentimes those fees are really eating up a significant portion of the gains. And so, again, if you're not able to go and dig through what's really happening on the numbers in that fund, you sort of find yourself at a disappointing place when you realize that, wait a second, my money could have grown twice as fast if I had diversified a little bit more. What happens in a situation? So if you were talking about the example of where someone is able to place a lump sum, would a lump sum typically be available if someone was leaving a career, for example, or they needed to, say you worked for an employer and you shifted a 401k? Are you able to shift some of those types of funds that may be accumulated at one location into another instrument when you leave that position, for example?
Yeah, absolutely. If you work for a company, you left that company, you have an account for 401k or IRA. Let's say 100,000, couple 100,000, you could roll it over to an annuity. Annuity is just considered as an IRA too. and that will protect your principal. So whatever you have in your 401k, you can roll over directly, and it's called qualified money. That means it's pre-tax money. So you can roll it over 100%. Let's say if you have 200,000, you roll over 200,000 into a safer investment, a safer plan, basically. And that will help you to grow and protect your principal. And whatever the interest that you earn is also protected at the same time. So it's great to have this part of your plan because it's considered safe money, and the earning are locked in, and it cannot be lost due to the negative index performance because your money is not directly invested in the stock market. So the market downturn doesn't affect. I mean, for that particular year, you may not gain anything, but your principal and the interest that you already earn are completely protected.
So I would think right now, I was listening to the news this morning and they're talking about, again, the tech layoffs. And so typically, if you get a layoff, sometimes if you've been with an organization for a significant amount of time, you might get some type of severance payment or something like that. This would be a good time to consider how you can take those resources that you received and do something with them to ensure that your principal is protected, but also that you plan for cash flow that you'll probably need, to protect you in the future. That's a great kind of news alert, right? If you're
Right.
being downsized, if you get a severance package, if you have a 401k that you need to figure out what to do, where to roll it over, definitely speak to someone and consider looking at an annuity as part of the decision about where you place those resources.
Yeah, and it's important that you do research before you do that because it's depend on the company, the rate of participation, the interest rate, and what type of annuities it is. Is it the right fit for you? Is it tax deferred? What is your goal? What's your need? So those are the things that you need to discuss with a financial professional that can help you clarify those, goals so that you can pick the right product that fits best in your scenario.
Absolutely. It's amazing. Sometimes we're so busy. I say this to entrepreneurs and I remind myself as well that we have to make sure that we're not just busy working in our business, that we're taking a step back and working on our business. And it's the same thing with life. You're managing your household resources, your earnings. You have to make sure that you're not just spending all your time out there earning the resources without really evaluating some of the ways that your resources can begin to work for you, right? That's smart money, putting your money to
Right.
work for you. Yeah.
And also your hard-earned money, put it to work,
Yes.
right? You spend so much time working for it. Now put your hard-earned money into work where it can generate more income for you for later on when you retire.
Absolutely. And I think some people I know have been interested in moving that marker, earlier as we look at the younger generations, meaning that many of them have opted for small homes or other types of living situations that would reduce their initial outlay towards housing. Some have said that they've been priced out of markets that they love to move into. And some of it is because, the boomers, again, are living longer. So some of the communities are real stable, therefore really expensive because there's limited inventory and, it's supply and demand, right? If you have limited inventory and there's a greater amount of demand, then that's going to keep the price at a premium. And others are opting to take, on a lifestyle that includes a little bit more balance. So I hear people talking about, I want to travel the world. I want to do this. So these are the kinds of vehicles that can be helpful in allowing you to have that type of option, for your lifestyle. If you have some other nest eggs that are accumulating and aimed at not only protecting your principal, but ensuring that you have a cash flow available as you need it.
Exactly. You can have an annuity that can fund your lifestyle, vacation. or even annuity. You can have an annuity for anything, for your LV bags,
Oh my
right?
goodness, I don't encourage that. But that's a smart way to, you're right, if it is you're gonna
But
do.
mainly for the retirement purpose here.
Yeah, yeah, I don't mind that idea. That was kind of one of the things I used to tell my son. Listen, I'm not against you consuming, but why don't you make sure that the things that you're going to consume a lot of, maybe you should own some of the shares in the company, so at least you're on the receiving end of the benefits of that consumption, two ways,
Right,
right?
right.
Yeah.
Um, Just a quick note on variable annuities. We are almost at the end here. The variable annuities is based on the investment performance of the stock market. So it will go up and down depending on the underlying stock, bonds, or money market in this investment option that you put your money in. So those are the three options for annuities. So when you to pick the right one, consider what's your risk tolerance, what's your investment goals, what's your time horizon. So it's important to discuss that with your financial professionals to come, to come up with the right plan for you. And also for annuities, there are riders that you can add on, like long-term cares, cost of living, accelerated, or living benefits that you can add on to the annuities. So those are the things that you need to discuss when you have a need for annuity plan setup. So it's important that you discuss that, concerns with your financial professionals when you're coming up one.
Absolutely. Well, hopefully we've laid a little bit of a foundation about annuities and at least got you, creatively thinking about some ideas. You can definitely send an email to us and we're happy to, take a look and give you some feedback. You can reach us at info@wealthdoctors.us. Our information is scrolling along the screen, and you can also tune in again next Wednesday. What are we talking about next week?
Uh, that is to be a surprise, right?
But you can guarantee it's going to be something about helping you understand more about the use of insurance tools and products, as well as other capital strategies that can assist you both personally as well as professionally, business wise, right? Along your
Right.
journey. So we hope that you like what we've been sharing, and we hope that you continue to tune in.
Well, thank you for joining us today, and we appreciate your presence and hope you found the session helpful. We go live every Wednesday at 10 a.m. Pacific time. Plus, please join us next week for more exciting content. Until then, have a wonderful day.
All right. Take care, everyone. We'll see you next time. Be well.
Be well.